Hi guys, welcome to another video. In today's video we're going to be talking about cannabis and mainly the company Canopy Growth. Serious guys, in this video I just want to show you how the sector is performing and give you some awareness of the overall situation. I'm not going to tell you where to invest because this is still a very unpredictable industry, and as far as I know, I'm not seeing the cannabis era yet. My purpose is just to clarify you in which is the situation impacting the industry, and because I know many of you like this sector but don't know what is the best company and the most stable one, so on and so forth. So these are three of the Canadian cannabis companies, and as you guys probably know, the main problem in this sector is that these companies are investing a lot of money in the equipment and scaling all the production when they actually don't have the demand to return all these investments. So they have been struggling to really get profitable, and now this is the number one priority to almost every one of them. However, there are some things that differ between them, and for me the most important thing that you gotta look at is the balance sheet. I mean, the balance sheet is probably the only thing that can tell you whether the company is going to overcome its problems. So, looking here, we can see the Canopy, Aurora, and Aphria balance sheets and practically see which one of them is the safest one, with better conditions to grow in the future. And starting with Canopy, and I have to say that I'm not going to cover all these details to save time, but you can pause the video and look for yourself. And just to be honest with you, there are information left in these balance sheets. I just put the ones that interest me the most. You can find these on the firm's quarterly statements and see the complete information. So, we can see that Canopy has a total cash and cash equivalents of about 1.5 billion Canadian dollars and a total current liabilities, which basically is the money that the company has to pay within the next 12 months, is the current debt. So as you can see, this is a very good sign. This tells me that Canopy, even if doesn't sell any cannabis this year, they can still pay off all their debt and be healthy. And for the case of Aurora, it's basically the opposite, as they don't have enough cash to cover all the current liabilities, and that's not good to see. Obviously there are other aspects that we need to consider when trying to be the most accurate possible, but I'm just saying that for me this is probably the most important thing. And I mean, these companies have suffered huge sell-offs, and you can say that this is due to the management, and it can be, but most of them have got new CEOs recently, and the result of this new management is just gonna be visible within 1 or 2 years. So for now we gotta stick with the financial positions so we can predict which ones are going to survive in the near future. So moving on, Aphria is a very stable company as well. You can see that they also have enough cash to cover the current liabilities. And just looking at the balance sheet, you can see that Aphria is very attractive, just as well as Canopy is. But in this video I want to cover the Canopy business to see if the advantage that they have could potentially turn out on a very successful business heading into the future. I'll maybe be covering the Aphria business on another video, but for now let's stick with Canopy. And for this video I'll just focus on basically the most recent actions, which means I'm not going to be analyzing what the company has been done in the past. In my view, the thing that matters the most for this type of companies is the present and the future. See if they actually can handle the situation and come out profitable. So if we look at the business itself, Canopy Growth operates in cannabis sector, both for medical and adult use market sectors. Canopy Growth operates retail stores across Canada under Tweed and Tokyo Smokes banners, and they have operations in over a dozen countries across 5 continents. Also, they have a lot of subsidiaries, which means they own a lot of brands in this industry, which lowers up the competition as well. So from here you could be arguing that Canopy is a very big company and should be doing pretty well. However, as I told you in the beginning of the video, the market is not quite there, and although it has been growing, several countries have not yet legalized cannabis, and it's quite difficult to these companies actually scale up their business internationally without the demand. With that being said, it seems like Canopy took a step back and sold a lot of facilities recently that they have so they can save up the money. So in this article it says that Canopy Growth Corporation announced today that the company plans to close its facilities in Aldergrove and Delta, British Columbia, resulting in the elimination of approximately 500 positions In addition, the company no longer plans to bring a third greenhouse online in Niagara-on-the-Lake, Ontario. These actions are part of the company's effort to align supply and demand while improving production efficiency over time. And also, as you can see here, nearly 17 months after the creation of the legal use market, the Canadian recreational market has been developed slower than anticipated, creating working capital and profitability challenges across the industry. Additionally, federal regulations permitting outdoor cultivation were introduced after the company made significant investments in greenhouse production. The company now operates an outdoor production site to allow for more cost-effective cultivation, which will play an important role in meeting demand on certain products that rely on cannabis extracts. Following an organizational strategic review of production capacity and forecasted demand, the company announced today that these facilities in Aldergrove and Delta, British Columbia, are no longer essential to its cultivation footprint. And as you can see, they are going to save up the money, which is crucial. And I want to finish with this part here, which says that along with this announcement, the company expects, based upon information currently available to management, to record estimated pre-tax charges of approximately 700 to 800 million in the quarter ending March 31, 2020, reflecting today's announcement as well as additional changes related to its organizational and strategic review. This is a very good thing to read, at least tells me that the company isn't going to run out of cash soon, and also I think it was the right thing to do, as you can understand looking at these statements here. Looking here, we can see this was published in the second quarter of 2020, so the end of 2019. It says that the kilogram and kilogram equivalent sold was about 13 million, as the kilograms harvested were 29 million. So this is a problem. They really need to stop harvesting kilograms because they really can't sell them. That's why they need to sell the facilities. Also, Canopy bets on the well-being of the society. They have a project to support the community, and I personally like these companies who embrace these projects and give a contribute to the society. So as you can see, as far as we go on, it seems like the company is doing the right steps to profitability, but we have to look at the global situation right now, and as announced, Canopy has closed all the retail stores and moved all the business to e-commerce. And despite these actions have impacted the business, they still find consumers through the e-commerce platforms. With all that cash on hand and short-term assets, which are money that they can liquidate pretty easily, I think the company will overcome this bad dream comfortably. Looking at the stock itself, Canopy have been experiencing massive sell-offs. If you look at the 1 year chart, we can see that the company has been down from its peak on April 2019 all the way down to $9 here, but yet recovered to 14 due to the expectation that the cannabis sector is going to surge during these times. I think it's a very hard thing to say. And to resume, basically the problem is this. So if you look at the revenue and comparing with the operating expenses, you really can see that they are wasting money, which leads them with a very poor business with no profit. So that's kind of the problem that these companies have. The whole sector needs to adjust. And actually it's not worth to look at any more data. The company stands on a very speculative valuation. You really don't have the numbers to say if they are undervalued or overvalued. It just depends on the performance of the overall industry and whether it's going to surge in the near future or in the long run. The fact is, when it surges, this sector, and I think particularly this company, is going to do amazing. With that said, I really hope you liked the video and found it helpful. If you did, please leave a like and subscribe to more videos like this one. And as always, do your own research. Don't trust on me. I'm just here to give you information and a little bit of my opinion. Hope you all the best. Peace.